What we will try and see here is that as the Indian economy has opened up to liberalization, whereby the current account becomes convertible in 1994 and the exchange rate has been largely market determined since March 1993 and the capital account has been progressively liberalized. Monetary policy has had to face new challenges from large and growing capital flows.
After studying this module, you will be able to understand the problems that are faced when the economy has become liberalized, learn about the impossible trinity, understand how to manage impossible trinity. The period prior to 1990 was characterized by fiscal dominance and associated financial repression that, inter alia, necessitated administered interest rates, large statutory preemptions for financing the fiscal requirements, sectoral credit targets, tightly controlled and regulated economy. Since the early 1990s, the overall economic environment has changed substantially from that of a tightly controlled and regulated economy to one benefiting from a growing degree of deregulation and liberalization, both domestic and external. Statutory preemptions have seen significant reduction, interest rates have been deregulated, although still not fully. Financial markets have seen progressive deepening, widening, and integration over the years. The external sector has witnessed significant liberalization. The current account became convertible in 1994, and the exchange rate has been largely market determined since March 1993. The capital account has been progressively liberalized in terms of inflows as well as outflows.
Monetary policy signals are now largely transmitted through changes in policy rates. Legislative amendments have been undertaken to provide the Reserve Bank of India greater leeway in its monetary operations.
The various reforms that have taken place since the early 1992 have thus provided greater flexibility in the conduct and operations of monetary policy. At the same time, monetary policy has had to grapple with new challenges beginning 1993-4 from large and growing but volatile capital flows. Capital flows constituted 9% of GDP in 2007-8, much above current account deficit. During 2007, India was the highest recipient of net capital flows amongst all emerging market economies and the third highest globally.
First, let us now understand that large capital inflows are often associated with subsequent credit and investment booms, inflation, overheating, real exchange rate misalignments, current account imbalances, and financial sector weaknesses culminating in a financial crisis. Reversal of capital flows to the EMEs is often quick, as shown by the latest financial crisis, necessitating a painful adjustment in bank credit, collapse of asset prices, compression of domestic demand, and output losses. Thus, the boom and bust pattern of capital inflows can, unless managed proactively, result in large employment and output losses and macroeconomic and financial instability. Second, on account of such a boom and bust pattern, since the mid-1990s, many EMEs and regions, Mexico in 1994 to 1995, Asia in 1997, Russia in 1998, Argentina in 2001, and emerging Europe in the ongoing financial crisis have suffered financial crisis. Financial crises are more frequent than most people think, and they lead to losses that are much larger than one would hope. On average, there have been between 3 and 4 systematic banking crises per year for the past quarter century. In a sample of 40 financial crises, these authors found that 1/4 resulted in cumulative output losses of more than 25% of pre-crisis GDP, and 1/3 of the crisis related contractions lasted for 3 years or more. Whereas the crises in the recent past have largely been associated with EMEs and developing countries, the current crisis is that of advanced countries. In their case also, it is the expansion of the global financial imbalances that has been among the major cause. Third, this backdrop of recurrent crisis and large losses, it is noteworthy that despite the large volume of capital inflows and outflows, macroeconomic and financial stability has been maintained in India and in most other EMEs over the past decade or so. Thus, even as financial crises have been rampant across the globe, financial excesses have been successfully contained in India and other EMEs, even in the face of large capital inflows and outflows. Fourth, let us now move on to discuss that how India has managed capital flows of such an order and still enjoyed high growth and financial stability. While theory commonly suggests that the combination of an open capital account, a fixed exchange rate and an independent monetary policy, impossible trinity or macroeconomic policy trilemma is not possible, most EMEs have managed their way out of this impossible trinity by moving away from the hard corners to the middle solutions. India too has managed the impossible trinity over the past couple of decades and the outcomes have been satisfactory.
It is an accepted tenet of open economy macroeconomics that the combination of an open capital account, a fixed exchange rate, and an independent monetary policy, the impossible trinity, is not feasible. Countries can attain any two of these three objectives, but not all the three simultaneously. Thus, with an open capital account and a fixed exchange rate, an independent monetary policy is not possible. As countries have opened their external accounts, both current and capital accounts, and as the Bretton Woods system broke down, it has been generally accepted that the operation of an independent monetary policy necessitated the operation of fully open capital accounts and floating exchange rates. This has been the general macroeconomic and monetary policy regime followed by advanced countries.
The practice followed by EMEs and other developing countries has, however, been different in recent years. Whereas the theory appears to restrict the choice to the hard corners of policy, it does not seem to have dealt with the possibility of operating in the middle. With the experience gained from the Latin American debt crisis of 1980s and 1990s and that of the Asian crisis in the late 1990s, most Asian and Latin American EMEs have eschewed both closed capital accounts and fixed exchange rates as has India. However, in most cases, they have practiced different degrees of management of the capital account while keeping it relatively open and have also practiced managed floats of the exchange rate, implying the considerable flexibility but not a free float or a fixed exchange rate. This practice has enabled them to retain monetary policy independence, and in that sense they have managed the impossible trinity. The conduct of policy reflects the recognition of the actual cost and benefits of a fully open versus managed capital account and of a completely floating exchange rate versus a managed but flexible exchange rate. India's macroeconomic, monetary and external account management has very clearly been of this genre.
A key area of concern and vulnerability for EMEs is on account of volatility in capital flows. Surges in capital flow are often followed by sudden stops. This volatility is often the consequence of the monetary policy stance and other developments in advanced economies unrelated to those in EMEs. Low interest rates in advanced economies encourage outflows from these economies into EMEs in search of yields, as witnessed quite conspicuously in 2010 on the back of unprecedented quantitative easing in the US and other major advanced economies. Thus, interest rate cycles can generate cycles in capital flows to the EMEs.
First, the recent financial crisis. EMEs suffered despite the existence of strong domestic fundamentals. This was reflected in a sharp reduction in the net capital flows in 2008 to 2009 from their record high level in 2007. Such a fast turnaround in capital flows, if not managed actively by the policy authorities, has serious consequences for the domestic economy and overall financial stability. This was brought home very starkly in the latest episode of the subprime financial turmoil. Second, there has been a sharp expansion in the volume and volatility of net capital flows. There has been an even more significant growth in underlying gross inflows and outflows. It is these inflows and outflows that have greater impact on the daily exchange rate movements and expectations relative to the net flows. They are often more important from the policymaker's point of view. Gross inflows and outflows of capital are also relevant in the context of the recent global credit bubble. Third, to understand the phenomenon of the global credit bubble, however, gross capital flows are far more important than the net capital flows. The gross capital flows do not necessarily correspond to the saving investment balances as a national and regional level. In fact, it was Euro area banks that strikingly expanded cross-border lending, while the Euro area as a whole did not register a current account surplus.
Let us now discuss exchange rate volatility. Sudden and substantial exchange rate movements constitute an important channel through which capital flows can potentially have an adverse impact on the domestic economy. The impact of exchange rate changes on the real sector is significantly different for developing countries as compared with that for reserve currency countries. For a majority of developing countries and EMEs, which specialize in labor intensive and low and intermediate technology products, profit margins in the intensely competitive markets for these products are very thin and vulnerable to pricing power by large retail chains. Therefore, exchange rate volatility has significant employment, output, and distributional consequences. Let us now discuss how should central banks react to exchange rates. The conventional view is that policy interest rates should respond primarily to inflation and real GDP and not to exchange rate movements. Such recommendations are based on models that assume a considerable degree of effective globalization. However, from the perspective of EMEs, such recommendations are perhaps not appropriate. In the current state of the art macro models, there is no room for such things as bubbles and banking system collapse.
It is generally believed that trade deficits should lead to currency depreciation. What is the actual global experience on this issue? It is interesting that contrary to what might be expected, a simple analysis of current account balance and exchange rates for a sample of 36 countries indicates that current account deficits are associated with both nominal and real appreciation. Thus, at least in the recent decade, countries with large current account deficits have surprisingly experienced a tendency for their exchange rates to appreciate, which can have significant deleterious effects on their real economies. With open capital accounts and rapid movement of capital flows, it is these flows that dominate the effect of current account deficit and drive exchange rate dynamics. Corrections do take place, but these are with substantial lags and often end up in a crisis.
The conventional models focus on implications of exchange rates on price stability. But, as the current global financial crisis has shown, price stability does not guarantee financial stability. Exchange rate dynamics in an open capital account run the risk of creating financial fragilities. Hence, there seems to be an important role for policy authorities, not necessarily through interest rates, to ensure that large real exchange misalignments do not persist for long periods. This involves active capital account management, intervention and sterilization, along with the continuous strengthening of the financial sector. With the increase in cross-border capital flows, the exchange rate appears to be influenced more by these flows rather than by developments in the current account, which perhaps reflects economic fundamentals better. Since capital flows are much more volatile than current account flows, they are subject to herd behavior, leading to excess flows and sudden stops. Therefore, EMEs have had to resort to some degree of capital account management and associated forex interventions, influencing movements in the exchange rate.
Over the last decade, the Indian experience with respect to overall macro management has been broadly similar to that of other EMEs in Asia and Latin America. It has also eschewed corner solutions in exchange rate and capital account management while practicing an independent monetary policy. Against this backdrop, the next section provides an analytical assessment of the management of the external sector in India since the early 1990s, with particular focus on the management of the capital account and exchange rate. It also critically assesses the efficacy of capital controls. The chapter then discusses how the monetary management was conducted in context of volatile capital flows. The issues that are discussed here are how the monetary policy framework was employed, the mode of liquidity management, and the range of sterilization instruments or operations that were used. This also includes a discussion of the prudential measures used to supplement the monetary policy so as to manage the impossible trinity and ensure financial stability. The chapter then undertakes an assessment of the outcomes in terms of key monetary and macroeconomic variables like credit, money supply, the health of the financial sector, inflation and growth. The outcomes in the Indian context are compared with those in the other economies. The concluding section sets out the key lessons from the Indian experience. External sector policy has witnessed very significant changes as a part of the overall economic reforms practiced in India since the early 1990s. The economy has been opened substantially over this period. The hallmark of the policy has, however, been that of gradualism. The current account was gradually liberalized over the 1990s with the elimination of quantitative trade restrictions and gradual reduction of tariffs, which are now close to ASEAN level. Current account convertibility obligations under the Article 8 of the IMF were accepted in 1994. Capital account liberalization was more gradual. It has been seen as a continuous process rather than as a one-off event contingent upon the progress in fiscal consolidation and in financial sector and real sector reforms. This policy stance was adopted in the early 1990s when the capital account liberalization was being recommended strongly as a goal. It was only subsequent to the Asian financial crisis that more conscience crept into the international approach to full capital account opening. In this approach to the opening of the capital account, India clearly recognized a hierarchy in the capital flows. It was favored equity flows over the debt flows and foreign direct investment over the portfolio investment. The Indian capital market has been opened to the institutional portfolio flows, but with some limits on the share of domestic companies that can be held by foreign portfolio investors both individually and collectively.
Let us now move to management of the external account in India. It has witnessed very significant changes in India since the early 1990s. The current account was gradually liberalized over the 1990s with the elimination of quantitative trade restrictions and gradual reduction of tariffs, which are now close to ASEAN levels. Current account convertibility obligations were accepted in 1994. Capital account liberalization was more gradual. It has been seen as a continuous process rather than as a one-off event, contingent upon the progress in fiscal consolidation, financial and real sector reforms.
A more conscious approach has been followed with regard to debt flows. Portfolio investment in both corporate and government debt are governed by overall quantitative limits. The access of the non-financial corporate sector to the external debt has been liberalized gradually, but is subject to adherence to the criteria related to purpose, interest rate spreads and magnitudes of borrowing. These controls have been modified from time to time depending on the volume of the capital flows. The access of financial sector intermediaries has been subject to more prudential restrictions in recognition of the greater hazards associated with such external borrowings. Capital outflows have also been liberalized progressively. All inflows by non-residents are freely repatriable. Resident non-financial companies have been enabled to invest abroad relatively freely with few restrictions. Individuals are, however, not permitted to borrow abroad. It is often argued that deep financial markets helps in channelizing the large and volatile capital flows efficiently. If capital flows reach the level as high as 9% of GDP, as they did in India in 2007 and 8, it is debatable that even a highly advanced financial system can intermediate such capital flows efficiently and in a stable manner. For such a large volume of capital flows to be fully absorbed, an equivalent current account deficit or large real appreciation or a combination thereof would be the immediate consequence. These outcomes would in turn be manifested in asset price and credit booms and financial imbalances. Accordingly, in India, a multi-pronged approach has been pursued to manage the volatility emanating from capital flows. These include calibrating the policy regime in regard to the debt component of the capital inflows or outflows, distinction between the financial intermediaries and other resident entities, liberalization of policies in regard to capital outflows, flexibility in exchange rate movements, and interventions to smoothen the volatility. Forex market interventions are sterilized through modulations in cash reserve requirement and open market operations, including through issuance of government securities under the Market Stabilization Scheme known as MSS. Repo or reverse operations under the Daily Liquidity Adjustment Facility also help to modulate liquidity. Prudential tools have been judiciously used to supplement the monetary measures to contain financial excesses. More generally, prudential financial sector regulation has supplemented the capital account management to ensure resilience of the domestic economy.
In this module, you have learned that the process of financial liberalization during the 1990s necessitated a complete reorientation of the operating policy framework. The Reserve Bank had to develop an array of monetary policy instruments which could effectively modulate monetary conditions in alignment with the rejuvenated process of price discovery. Besides, shifts in monetary policy transmission channels necessitated policy impulses which would travel through both quantum and rate channels. Finally, the episodes of volatility in the foreign exchange markets emphasize the need for swift policy reactions, balancing the domestic and external sources of monetization in order to maintain orderly conditions in financial markets.